measure results, you tend to get better results. When you're looking at all these reports, it just puts your team on notice as an owner and executive that you're actually looking at their work.
Today, we're going to talk about the 7 financial reports for every business owner to review regularly. Hello, everyone. I'm Thomas McMillan, your host today, and I'm here with Eric Rourke, who's the CEO of Rourke. How are you doing today, Eric?
Doing fantastic, Thomas. Thank you so much. Really fired up about the business reports that owners and executives should be looking at every month.
So let's first talk about the first one, the income statement. What's an income statement?
Income statement is key, guys. That's also known as your profit and loss statement. So that tells you your revenues or your money that should be coming in, as well as your expenses and your money going out. So obviously your net of your income and your expenses comes down to your profit. And as business owners, it's not always what you make, it's what you keep. I think the most important thing, obviously, to be looking at is your revenue. And where does your revenue come from? What's really key when we look at the income statement and analyzing the income statement, there's a couple ways that we look at this. Way number one is to compare your current period to your past period, right? So that's very important. How are you doing as compared to last year? How are you trending? The other way to look at it is your income currently in the same period as compared to what your budget was. So whenever you set out a plan at the beginning of the year, whenever you did your budget or projection, how are you achieving along to that? One of the things that people commonly miss, but I think is so key, is to look at your income statement month over month. So you look at like a trailing 12 months, which would be the last 12 months from whenever, and then you're going to start seeing ups and downs, and things are going to start sticking out to you, not only the income side, but on the expense side as well. It's going to drive a lot of good questions. It's going to cause you to learn some things about your business. As business owners and executives, we get so busy kind of making decisions day to day. This is a good recap of how effective were those decisions and did they yield the results that you're looking at. One of the final ones that I've seen very few people do, but as I look at it as a business owner, but if you're ever feeling upset about what's going on or looking at it, one of my big things is go look at your 5-year trend. See what's happening in your business, right? So it's easy to get lost in a year, but if you start looking at what you built over the last 3-5 years, a lot of times you look back and go, oh my gosh, we did so much. And it's that good gut check of where you've been and where you're going. And that's one of the things that I always recommend to business owners, especially the ones that are really driven.
Everybody hears about the balance sheet. How should we use a balance sheet as a business owner?
Everybody hears about the balance sheet. Far too many people look at the balance sheet. So where your income statement is just currently how you're doing revenue expense wise, your balance sheet really shows your financial condition. How are you doing as a company? How strong or solid are you as a company? And so the revenue and expenses are transitory. In other words, they close out at the end of the year. Your balance sheet is really what you have. That's the assets that you own. It's the liabilities that you owe. And then the difference between those are equity. It's just like home, right? So you look at the value of your home, you look at what you owe on it, the difference is the equity. That's how it is in the company. Just we look at it slightly different from an accounting perspective. We use a thing called historical cost. So we don't record it at current market value.
How should someone really look at it as a very helpful tool for them in running their business?
The first thing I start looking at is what assets do I have? What do I own? So when I look at my assets, your biggest asset is going to be cash. And as we've talked before, to me, cash is the most important thing in the business, right? Cash is like blood in your body. You need it to stay alive and it needs to flow through your body. And you can lose some of it, but if you lose too much, you eventually die. That's the same thing with your business. But depending on your industry and your business, you're obviously going to have assets. So you want to make sure you're fully utilizing your fixed assets. Are we getting them? Are they being the most efficient? You're going to want to look at your accounts receivable. Are these things that I can actually collect? Because revenue typically is accounts receivable. That's not true in all industries, but it's typically accounts receivable. And it's really not revenue until it becomes cash, right? In my mind. And then your liabilities. How indebted are you? How leveraged are you? It's so important to make sure that you're maintaining the assets above and maintaining equity in the business is going in the right direction. It'll be incredibly important for lending, and it'll be hugely important whenever you go to sell.
Let's talk about covenant projections.
Absolutely. So look, every organization that borrows, or typically that borrows, has some kind of covenants that they have with the bank. And a covenant is a promise basically that I make to you on how I'm going to run my business. And there's a funny thing about lenders, Thomas.
Mhm.
They just want to get their money back. So it's really as simple as that. If you can show them how they're going to get their money back and they can get their interest or whatever they make, that tends to make them pretty happy. If you can't, then they get nervous. But so these covenants are really important. And what you're going to want to do is you're going to want to take and look and see how your performance has been, where you're currently at. Because if you're out of covenant compliance, then that may cut off your borrowing, or even harder things, going to receivership. So you want to actually get in front of that and start projecting. You want to know where you're at with the covenants and where you're going with the covenants. And that way you're in compliance. And if there's any, so one of the things that I would highly suggest, if there's anything going on with the covenants, or you're out of covenant compliance, or you think you will be, make sure and be certain. Obviously, you don't want to have a error in your spreadsheet. But if you really are finding that you're going to be that way, go and be proactive with your lender. That and explain what happened. What you're going to say is, here's what happened, here's where we're at, and here's what I'm going to do to make it better. That will go miles. And most people are afraid to do that. But at the end of the day, they're going to know, because you got to report to them anyway.
The fourth one that we have is, it seems natural, but budget versus actual report.
You would actually be surprised how many small businesses, especially, actually don't even do budgets, right? It's like, hey, we're going to do the best we can. But what's that old saying? If you fail to plan, you plan to fail, right? So this goes back into your planning aspect. And it's one thing to have these great ideas, especially with entrepreneurs, on what you want to do. But it's another thing to put pencil to paper and make sure that you're getting the return on investment that you expect. That's super important. So your budget's just really your plan that you set out at the beginning of a year, typically, to be able to say, where are we going? The difference between budgets and forecasts is forecasts will be updated as you go along. So this could be a budget versus actual, or forecast to actual, and where we're at, just understanding those trends. But it's going to really bring out key areas where companies have missed. So if you have a big departure, say in revenue from your budget, then it's what happened. And there could be perfectly great reasons that are not due to performance. There could be performance reasons. Hey, we lost half of our sales force because someone paid them more, or whatever the market conditions. Okay, those are things that are tough. Or we could say, hey, we've had all these salespeople and they just, none of them met their goal. Same thing goes into expenses. The funny thing about budgets is the one number that I promise you won't hit is what you put on paper. And if you do, then either you're really good, or it's very steady, or something's wrong. So if you're hitting your budget numbers on the nose, that's a good hint to look into a little bit more. These budgets are meant to be flexible. Business is dynamic, right? Sometimes you need more investment. Sometimes sales are really good. Sometimes sales are bad. Sometimes a machine breaks down. These are just different things that are happening as you go along. But this budget to actual analysis is going to be very helpful in pointing those things out and raising issues that you may not have realized, or that just may be going on.
Next is accounts receivable and accounts payable aging report. Can you talk a little bit about what that really is?
Certainly. And accounts receivable and accounts payable. I remember when I was first going to school, I was like, what is an accounts receivable, right? An accounts payable. It's really an accounting term. But look, guys, accounts receivable is a list of stuff that you're owed, right? So it's an account. So you have an account with somebody, and receivable means that's money that they owe you. Let's flip that on the other side. These are vendor accounts and accounts payable that we need to pay. So commonly you'll have an aging report, which will talk about how long invoices have been out, either on the receivable side or the payable side. And this is a good report to look at. It gives you a good insight if customers aren't paying, if you have some concentration of credit risk. So if most of your customers are all not one customer, you're probably really going to want to stay on top of them. Or if someone's paying slowly, that's an indication you may not get money. And again, revenue isn't revenue until you get cash. That's not an accounting rule, that's an operational rule. Accounts payable aging, same thing. When I look at the key factors, your customers, your vendors, your employees, as well, those are all the key relationships that you're going to have in the business. There's going to be more, but those are going to be ones you're going to want to protect. So I think less of credit's given to vendors, because if you have the right vendors and you have the right vendor relationships, they should be partners, just like what you're trying to do with your clients. But general rule of thumb, and this varies by industry, like most people have 30-day terms. Again, varies by industry. So if you're starting to get 60, 90 days out, that starts becoming concerning. The flip side is if that's what you're paying and you didn't negotiate it. One key thing that's on accounts payable that not people look at enough, and I'd encourage you to go back to your purchasing departments, are early pay discounts. So you can get terms 110 net 30. So that means I'll give you 1% discount if you pay in 10 days. When you start, and look, we'll just do the simple math, and this is not the fancy finance calculation. That could be 12% return. That's a great return. Or you could get 210 net 20. That's not exactly how it works out, but that just gives you an idea of the power of financing and how you can leverage that in your business.
The next one we've got weekly KPIs.
I'm a huge fan of KPIs and scorecards. So just to take a moment, KPIs are key performance indicators. And the reason why we call them weekly is you should be looking at them weekly, right? So your financial information will usually come out between 5 and 15 days, just depending on your company, maybe 3 if you're a publicly held company, after the month, right? So the months already happened, but then they come in blocks of months. But your KPIs are really your pulse on your business, right? Your business operations. So when we talked about tax reporting, financial reporting, and operational reporting, and management reporting, this is your management reporting. You should be looking at them each week with your management team. Your team should be sharing these because these are your real-time issues and problems that you can fix, become more efficient, pour more dollars to the bottom line. A lot of times these are done by department, functions, teams. And just a couple examples like marketing, maybe you're looking at new leads, and everybody's got different KPIs. It's very company specific. Maybe you're looking at new leads, maybe you're looking at conversions, new subscribers. There could be a number of things. Sales dollars, how much are you selling? What's your margin percentage? Those things, quotas, those are very common. Operations, typically you'll have a customer service, like how quickly do you deliver your service? How efficient are you in your service? Accounting, a popular one's close days, HR, maybe like employee turnover, or a big one is the cost to train a new employee. When we talk about employee turnover, it is so expensive when you think of the cost to hire, retain, onboard, train, to get them up to speed where the other employee is. You know, depending on the position, this is anywhere from a 3-month to a year curve, maybe even sometimes longer. And then IT may be like user time, user uptime, downtime, incident requests, those type of things. One of the things that a lot of people hear a lot about, and I think this is a great thing when you look at KPIs, is NPS, which is Net Promoter Score. So feedback from your clients. I have a passion for making sure that we serve our clients well in our business. And so that gives you good indications because your clients are your keys. And we actually call it customer value.
So finally, it's like every industry is different. And so obviously we have one that's allocated as industry specific reports. What are these? And could you give us some examples?
Certainly. And look, so we talked general reports that you should be looking at. But when you get into different industries, there's other key measures and metrics and things like that you may want to look at. Some of these may fall on the operations type of reports, but like for manufacturing, typically somewhere around 50% plus or minus 10 of your cost on your P&L is cost of goods sold, right? How much does it cost to sell something, convert it? And so your ability to be able to go from getting a raw material to conversion and sales out the door is huge. So I look at 2 different ways. One's a rate variance, which is like your purchase price variance or your labor rate or your overhead spending variance. This is what you're budgeting that it's going to cost you per whatever unit. And then there's efficiency variance, which is how quickly do we get these things converted? And those are commonly called material usage, labor efficiency, or overhead absorption. Those are key. Warranty costs or defects are very important as well. When we look at construction, just looking at the bid to actual, kind of like a budget to actual. So typically on long-term contracts, you're putting together a bid. And the question is how close did you come to your bid whenever you priced it out? And you should be monitoring that real time with your WIP reports. And then you can make adjustments on the fly for, are things running over? Are things going under? one of the common things that we see in doing these evaluations is there's change orders that aren't being processed. That's a good red flag for change orders and having those discussions earlier as opposed to later. Distribution e-commerce, like inventory turn, is super important, how quickly that inventory is turning, because a lot of your capital is sitting in the products itself. Shipping, especially with the commodity pricing, has a huge impact. Gas prices and oil costs, that has a huge impact in margin. Transportation, on the flip side, fleet utilization. A lot of our clients set up each power unit or tractor as profit centers, so they want to look at what they're putting into it, maintenance, repairs, driver costs, costs for the unit itself, and just see that each one's kind of its own profit center. And then hospitality has been huge right now. Obviously, it's coming back with a roar, but average cost per plate or sales per plate per ticket, time on tables, because you want to upsell as much as you can, have as much churn as you can, that drives revenue. And then a lot of companies have adopted in hospitality predictive analytics. That's huge for making sure that you have the proper labor. So you don't want to have no one there whenever you have all the customers there, it drives them away. Also making sure that you have the product. And because spoilage is so prominent in that industry, you got to make sure that obviously you're matching your demand, your supply with your demand.
Well, Eric, the way I look at those 7 financial reports that we just went through, counting the industry ones, which each one had its own separate one, those are some really critical reports on running a business well.
They definitely are. And look, the 7 sound like a lot, and we talked a lot about them. But what I really say is the key thing is set out your reports and start 1 or 2, at a time, and then you're going to gradually increase. The first thing I cancel business owners on, every month, look at your income and balance sheet. And some people are like, hey, Eric, I don't want to look at my income and balance sheet because I don't know what it means. That's okay. Ask dumb questions, right? If that's what you need to, but get educated. Because like I said, it's so important that your team, your leadership team, know that you're looking at it. And you should be, after time and asking questions, I've seen business owners that didn't know and were afraid and become very educated and very financially strong. So that's huge. KPIs are so critical to me. That's your pulse on your business. If you really just start with 3 reports, get that income balance sheet and KPIs, get that in place, and you will see the benefits and the profits from it if you stay disciplined and look at these reports. And it doesn't take a lot of time. Hey, these are 7 reports. There's a lot of reports that are out there. I would love to hear from all of you guys. What are some of the key reports that you guys use in your business? What's been impactful? What's been helpful? Let's share it so we can share with the community in ways in order that we can help each other. So please let us know in the comments below the different reports and things that you look at.